folks, Lucas Ballahud here with Coldwell Banker RMR Real Estate and the Ballahud Group. Welcome to this week's episode of Finance Fridays. Now, I'm going to shoot this one here solo today. Alexandra is dealing with a little bit of a bug at home, a little bit of illness there, and we certainly wish the whole family a speedy recovery. There's something non-COVID related going around, and I've spoke to a number of whether they're friends, clients, family members that have been hit by something recently. So folks, certainly seems like we're getting a little bit of kickback after not socializing and getting regular germs here over the last couple of years. So we're all kind of getting building that immunity back up again. So anyways, we do hope Alex is back with us again soon, and we look forward to recording with her again in a couple of weeks here. But what I want to speak to you about today is 5 investment strategies that we see in real estate here in Ontario. And this is, I think, a relevant topic for us to discuss today because the market has certainly gone through some changes over the last 12 months, right? Or it's going on 12 months now. The Bank of Canada has been raising rates since January of this year, and we just saw an announcement a few weeks ago, at the end of October. We should be expecting another increase from the Bank of Canada on December 7th as well, and probably another one into the spring in 2023. We'll see how things go, but they're really doing this to try and slow that rate of inflation down and get it under control. So until inflation is, dead, they're going to keep raising rates. So this is why this is a relevant topic today for those who are looking to invest in the real estate market as prices are coming down. So 5 strategies. The traditional strategy people are very familiar with, and I know certainly my family's been involved in this kind of thing for a long time, is buying and holding real estate, right? You buy the property and you rent it out, and essentially you're making money off of those rent payments from the tenant, assuming that's a positive cash flowing property. And, over time, because you're holding this asset for, the long game here, we're talking 10, 20, 30 years, hopefully, in some cases here. And, eventually when the property is, say, mortgage free, you've got a property at that point that's fully cash flowing positively, and it's money in your pocket at that point, right? Traditionally, you're going to need, for an investment, something that's not a primary residence, you're going to be required to put 20% down on the property. So if you've got some liquid assets that way in terms of cash capital, that's a strategy that is tried and true. And as the market, continues to receive this downward pressure on pricing, there's going to be opportunity for people here to who are a little bit more liquid to acquire real estate and hang on to it. Another strategy that's a very common, more well-known strategy is the flip, right? And that's where, we know, and we see a lot of shows on television about this kind of thing, where you acquire a property under market value, you go in, you gut it or renovate it, and then you sell it shortly thereafter for a profit, right? That's a very popular strategy. Certainly the government of Canada has been, taking steps to try and, increase taxation on this kind of business and these kind of transactions. And certainly there's a lot of political things that go into those discussions, or into those initiatives. But that's typically what the flip is: buy low, sell higher after you put some money into the property and increasing its value that way. Something we're probably going to see a little bit more these days is a hybrid model of the buy and hold and flip. So, what that would be is a little bit more, you're buying the property, hopefully under market value, and you're doing some improvements to the home. They might be somewhat significant at that point in terms of, the extent of work that needs to be done to the home. But, that might be a 6-month period or something like that you're holding onto the property. Maybe in this market, it's a little bit more like a year. And you're renting it out after the renovations are completed, and then you're selling it later. Right, so it's a bit of a hybrid of the two. It's not a quick flip, as in the second model or approach that we talked about. The 4th strategy here is a joint venture, or JV, as is commonly known. And this is where, let's say an individual buyer doesn't have the funds to buy a property individually. Maybe they don't have the 20% down or what have you, or they want to just hang on to that capital for, so it's available for other initiatives. And you partner up with 1, 2, or more people to create a joint venture. So everyone's putting in assets to buy the property, You're also putting capital up to renovate it if that's necessary, or carry it on a cash flow basis. And then, you're maybe going to try and get some more traditional financing later on as the situation changes, things like that. And at that point, you've got a partnership in place. Everyone shares in the expenses. You share in the benefits as well. So if you decide to sell it or you decide to hang on to it and play the long game, the buy and hold under that joint venture strategy, there's certainly several options there that the joint venture strategy can present. So that's the joint venture approach. The last one I want to touch on is the rent to own strategy. So this is gaining a little bit more traction and popularity here in Ontario. Kind of how it works is if you're the typical investor at this point is going to acquire a property or have a property available, and a potential buyer might just not have the funds, maybe it's down payment or what have you, to qualify to purchase the home, right? So at that point, you're charging you work out an agreement where you're going to charge them, rent that is ideally going to be at market value, and also an additional fee that you're going to negotiate with them that is essentially being paid to the owner, the landlord, to as a credit towards a down payment for the future. So you might have an arranged, predetermined date that the individual is going to have accrued enough or paid in enough of that additional cost, towards the down payment that it'll allow them to qualify to buy the home, and that kind of thing. And so that's a more creative version that you're certainly looking for highly qualified applicants, ones with good credit and all those kinds of things that gives you, the owner, some peace of mind that you're not going to have someone occupying the property that's not going to pay, or not going to be able to pay both the rent and that additional charge. This is a bit of a unique approach that is gaining a lot of popularity here. So it's a really interesting one, and I'd certainly like to dive into that one a little bit deeper in future episodes here. But those are your 5 strategies for investing: the buy and hold, the flip, the hybrid model. You've got the joint venture and the rent to own. 5 pretty popular strategies of investing in real estate. So with that being said, I'm going to leave it there for now, folks. Thanks so much for tuning in this week. I hope you're having a wonderful end to your November here, getting ready for the holidays. And we certainly hope to see you around soon. So thanks so much for watching. Have yourselves a great week, and bye for now.